The move that sent gold and silver to new records did not begin with a technical breakout or a routine macro shift. It began with a crack in institutional credibility. Markets are forward-looking, and what traders reacted to was not just price momentum, but a sudden realization that the structure meant to anchor. Monetary stability is entering a prolonged period of uncertainty. A criminal investigation touching the Federal Reserve Chair is not a normal headline. It directly challenges the perception of independence, authority, and continuity that global capital depends on. When that perception weakens, money does what it has done for thousands of years. It runs toward assets that do not require trust in committees, courts, or political outcomes. Gold and silver are not rallying because traders suddenly became bullish on metals. They are rallying because confidence in the system that prices everything else is being questioned in real time. The speed of the move is what matters most. Veteran metals traders immediately noticed that this was not a slow rotation or a hedge adjustment, but an aggressive repricing. Gold gaining over 2% in a single session at already elevated levels, and silver surging more than 7% signals urgency. That urgency reflects capital repositioning, not speculation. When Robert Yager described the rally as an eye-opener, he was pointing to the fact that seasoned participants rarely see moves of this magnitude unless something structural has shifted. Markets are beginning to price not just inflation or rate expectations, but governance risk at the very center of the monetary system. Once that risk enters the equation, it cannot simply be walked back with a press conference or a carefully worded statement. Silver ES reaction is especially important because it tends to lag gold in the early stages of fear-driven reallocations, then accelerate once confidence erosion becomes undeniable. The magnitude of silver ES move relative to gold suggests that traders are not only seeking safety, but also preparing for volatility, supply stress, and potential dislocations across financial markets. Silver straddles both monetary and industrial demand, making it highly sensitive to systemic stress. When silver moves this violently, it often indicates that markets are anticipating downstream effects, tighter liquidity, disruptions in credit, and pressure on institutions that rely on stability to function. This is not about a single investigation. It is about what that investigation represents. A challenge to the idea that monetary policy operates above political and legal conflict. At the same time, external volatility from political leadership is amplifying the reaction. Markets can tolerate policy disagreements, but they struggle with open institutional conflict. The combination of executive pressure, legal scrutiny, and central bank resistance creates a fog where future interest rate policy becomes unpredictable. Uncertainty is kryptonite for leveraged systems. As rate expectations blur, traders seek assets that are not discounted by future promises. Gold and silver do not depend on next quarter's guidance or next year's projections. Their value is immediate and absolute. That is why capital moved so quickly and so decisively. This opening phase is not the climax of the move. It is the signal that the market has begun to reprice trust itself. And once that process starts, it rarely stops quietly. What makes this moment more dangerous for traditional markets is that the reaction in precious metals is happening before any formal policy change, before rates are cut or hiked, and before the investigation even reaches a conclusion. That tells you everything about how fragile confidence has become. Markets are not waiting for outcomes anymore. They are front-running risk. When trust erodes, timelines compress. Capital does not sit patiently while institutions argue. It moves preemptively, and it moves toward assets that cannot be frozen, diluted, or redefined by regulation. Gold breaking records at these levels is not a story about inflation alone. It is a story about credibility being repriced. Silver following with outsized gains confirms that this is not a niche trade, but a broad shift in how risk is being assessed across the system. The Federal Reserve has always relied on one critical asset that never appears on its balance sheet: perceived authority. That authority allows markets to believe that policy decisions are insulated from politics, law enforcement, and public pressure. Once that belief is challenged, even temporarily, the foundation weakens. The Fed Chair's response to the investigation, regardless of intent, signals resistance, and resistance introduces conflict. Conflict introduces uncertainty, and uncertainty forces capital to seek neutrality. Precious metals are neutral by nature. They do not belong to any administration, central bank, or jurisdiction. This is why they become the default destination when power structures appear unstable. The rally is not emotional, it is logical. There is also a mechanical element at work that many overlook. Large funds, pensions, and institutions are governed by risk models that automatically adjust exposure when volatility spikes and governance risk increases. A DOJ probe into the head of the world's most powerful central bank triggers those models. Allocations shift, hedges expand, and non-correlated assets are increased. Gold is the first beneficiary, but silver's smaller market size makes it far more sensitive to sudden inflows. A relatively modest reallocation from institutional portfolios can overwhelm available supply, pushing prices sharply higher in a short time. That is why silver's percentage move dwarfed gold's. It is not that silver suddenly became more important. It is that it is far less liquid relative to incoming demand. Another critical factor is that this move is occurring against a backdrop of already tight physical markets. Years of underinvestment in mining, rising industrial demand, and persistent inventory drawdowns mean that there is little buffer left. When futures prices spike this fast, they send a message down the supply chain that physical availability may soon become constrained. This drives premiums higher, encourages hoarding, and discourages selling. In other words, price itself begins to reinforce scarcity. Once that feedback loop starts, rallies can extend far beyond what fundamentals alone would suggest. Markets are not just pricing current conditions. They are pricing the risk that conditions worsen quickly. This is why experienced traders are not asking whether the rally is justified, but how far it can run before something breaks. The combination of institutional conflict, policy uncertainty, automated capital flows, and physical market tightness creates an environment where traditional valuation models fail. Gold and silver are no longer reacting to data points. They are reacting to the erosion of assumptions. And when assumptions change, prices do not move incrementally, they gap. This section of the move is about recognition. The next phase is about consequences. As this recognition spreads, the behavior of market participants begins to change in subtle but powerful ways. Traders who would normally sell strength hesitate, not because they are euphoric, but because the downside risk now feels asymmetric. When institutional credibility is questioned, there is no clear floor for how confidence might unravel, but there is a very clear ceiling on how much reassurance words alone can provide. This creates a one-sided psychology where holding metals feels safer than exiting them. Gold and silver become less about profit and more about positioning, and once assets shift into that category, volatility tends to expand rather than contract. That expansion is already visible in options markets, where implied volatility has risen alongside price, signaling that participants are paying up for protection rather than betting on calm. The silver market, in particular, begins to reveal stress in ways that paper prices alone cannot fully capture. A 7% daily move at these levels forces short sellers to reassess risk rapidly. Margin requirements rise, risk managers intervene, and positions that once seemed manageable suddenly look dangerous. This does not require a coordinated short squeeze to develop. It only requires enough pressure to force incremental covering. Each forced cover adds fuel to the rally, pushing prices higher and increasing stress on remaining shorts. This dynamic feeds on itself, especially in a market as relatively small as silver, where liquidity can vanish quickly during periods of uncertainty. What looks like a price surge on the screen often reflects a deeper liquidity vacuum underneath. At the same time, industrial consumers are watching closely. Silver is not just a monetary metal, it is a critical input for electronics, solar panels, and advanced manufacturing. Rapid price increases and heightened volatility introduce procurement risk for these industries. When buyers fear that prices could be even higher tomorrow, or that supply could tighten further, they tend to accelerate purchases. This front-loading of demand can temporarily overwhelm available supply, intensifying upward pressure. Unlike speculative demand, industrial demand does not disappear when prices rise. It adapts by locking in supply earlier. This is another reason silver's move is so aggressive relative to gold's. It is being pulled from both sides at once. Gold, meanwhile, plays a different but equally important role. Its new record highs send a signal to global reserve managers, sovereign funds, and large pools of capital that are structurally conservative. These players do not chase momentum, but they do respond to shifts in systemic risk. A public confrontation involving the Federal Reserve invites questions about long-term policy stability, debt monetization, and the durability of fiat systems. Even a small increase in gold allocation at the sovereign level represents massive demand in absolute terms. That demand does not need to be visible day to day to matter. Its impact is cumulative and slow-moving, providing a powerful underlying bid that supports higher prices even during pullbacks. What ties all of this together is timing. This move is happening at a moment when markets are already fatigued by years of monetary intervention, political polarization, and debt expansion. The investigation acts as a catalyst, but the fuel was already there. Gold and silver are responding not to a single event, but to the realization that the margin for error is gone. In such environments, price becomes a messenger. It tells you that risk is being repriced faster than narratives can keep up. The market is no longer debating possibilities. It is positioning for outcomes. And that shift in behavior marks the transition from a rally driven by news to one driven by necessity. As the rally transitions from reaction to necessity, another layer of pressure begins to surface beneath the headlines, and that is the strain on market structure itself. Rapid price acceleration exposes weaknesses that remain hidden during calm periods. Clearinghouses, brokers, and counterparties are forced to reassess exposure as volatility rises, and this process often leads to tighter credit conditions within the trading ecosystem. When leverage becomes more expensive or less available, speculative players are squeezed out first, leaving the market increasingly dominated by participants who are either unable or unwilling to sell. This shift quietly changes the character of the rally. It becomes less liquid, more abrupt, and more sensitive to any new source of demand. In silver, this structural stress is particularly pronounced. The paper market is many times larger than the physical market, and sustained price surges challenge the assumption that contracts can always be settled smoothly. As prices climb, the incentive to demand physical delivery increases, especially among those who no longer trust financial intermediaries to perform under stress. Even a modest rise in delivery requests can strain available inventories, forcing exchanges and dealers to rely on cash settlement mechanisms or delays. While such measures may prevent immediate failure, they also reinforce the perception that paper claims are not the same as metal. That perception alone can drive further buying of physical silver, amplifying the divergence between futures prices and real-world availability. This is where psychology and mechanics merge. Once participants begin to question whether the system can deliver what it promises, behavior changes rapidly. Holders of physical metal become reluctant sellers, aware that replacement costs could be much higher. New buyers, sensing scarcity, are willing to pay premiums to secure supply. This creates a two-tier market where headline prices lag the reality on the ground. Historically, these conditions precede some of the most dramatic moves in precious metals, not because of panic, but because of rational self-protection. When trust weakens, redundancy becomes valuable, and redundancy in finance often means owning what cannot default. Meanwhile, broader markets are watching closely. Equity investors, credit markets, and currency traders all take cues from precious metals during periods of institutional stress. Gold's strength is often interpreted as a warning signal rather than an opportunity. It suggests that risk is migrating, not disappearing. As gold and silver absorb capital, other asset classes may experience increased volatility or sudden air pockets in liquidity. This interconnectedness means the metals rally is not isolated. It is part of a broader rebalancing that can feed back into rates, currencies, and even policy decisions. Central banks may attempt to reassure markets, but reassurance is less effective once price action contradicts the message. What makes this phase especially significant is that it unfolds quietly for most of the public. There are no emergency announcements, no visible crises on the surface. Yet beneath that calm, positioning is shifting in ways that are difficult to reverse. Once capital reallocates towards safety and tangibility, it does not rush back at the first sign of stability. It waits for proof, and proof takes time. In the interim, momentum builds, reinforced by structural constraints and behavioral feedback loops. This is how markets transition from disorder to revaluation. The rally in gold and silver is no longer asking permission from fundamentals or forecasts. It is asserting that the underlying assumptions of stability are under review. And when that review begins, prices tend to move ahead of consensus, not alongside it. As the metals rally gains momentum, another critical factor emerges: geopolitical positioning and the influence of global central banks. Gold and silver are not just commodities, they are strategic assets. Governments, sovereign wealth funds, and large institutional holders increasingly see them as hedges against uncertainty, both financial and political. When domestic markets are stressed, when central bank credibility is questioned, or when regulatory investigations create uncertainty, these actors accelerate accumulation. They are less concerned with short-term price swings and more focused on securing purchasing power and liquidity in a world where fiat currencies are losing perceived stability. This shift creates a strong undercurrent of demand that is largely invisible to retail observers, yet it fundamentally alters supply dynamics. In the context of the recent DOJ probe into Jerome Powell, the stakes are amplified. Investors are factoring in not only interest rate trajectories but also the credibility and continuity of policy leadership. A central bank under scrutiny introduces an element of unpredictability that cannot be easily hedged through conventional financial instruments. Precious metals, by contrast, are universally recognized, globally liquid, and immune to counterparty default risk. For traders and institutions alike, this creates a compelling case for increased allocation to gold and silver, particularly during periods of heightened scrutiny. The combination of political uncertainty and rapid price movement reinforces each other, accelerating the pace of accumulation and creating conditions ripe for historic rallies. Silver, in particular, becomes a focal point because it straddles the line between industrial commodity and monetary asset. Industrial demand continues to grow, fueled by technology, renewable energy, and manufacturing needs, while its monetary characteristics make it attractive as a hedge against currency debasement and financial stress. The dual nature of silver creates an environment where multiple forces converge. Industrial consumers are willing to pay premiums for guaranteed supply, while investors are willing to pay for scarcity and security. When these two streams of demand coincide, the result is not a typical market correction or minor rally. It is a structural upward pressure that can sustain itself until the physical supply is truly challenged. Another important consideration is the role of derivatives and market mechanics. Futures markets and options amplify movements because they allow leveraged positions and hedging strategies that can cascade rapidly. When prices accelerate beyond historical norms, automated hedging triggers and risk management protocols can create feedback loops. These loops magnify price action, not by speculation alone, but by the mechanical need for institutions to rebalance exposure. In silver and gold, where physical supply is finite, these cascades have real consequences. Paper contracts may be settled, but physical delivery pressures become unavoidable once scarcity perception sets in. This interplay between mechanical trading and real-world metal is what makes rallies in precious metals particularly explosive and different from equities or bonds. Finally, investor psychology cannot be ignored. As gold and silver reach record levels, headlines reinforce fear and FOMO, fear of missing out. Retail and institutional investors alike respond to both price action and narrative. Historical parallels, from previous metal squeezes to fiat currency crises, inform behavior, and investors act preemptively. The rally becomes self-reinforcing. Rising prices draw more attention, more accumulation, and greater scarcity perception. At this stage, fundamentals still matter, but momentum, psychology, and structural constraints dominate. The market is no longer merely reacting. It is repositioning itself for a new equilibrium where metals are recognized not just as investments, but as critical stores of wealth in an increasingly unstable global environment.